Time for this week's stock picks. We'll start with Steve.
Yeah, I'm going boring, safe, given what we just talked about as far as Europe. And so I'm going to go with Walmart. As we saw in the last recession and muddle through economy period of 2008, 2009, that it was one of 30 stocks that in the S&P 500 that actually went up while the market came tumbling down. That's because as consumers feel tight, they ratchet down their behavior. They'll go to more discounters, certainly largest discounter in the world, retailing discounter. So you got super safe sales. You got the right balance sheet mix. You got 2.7% dividend yield. You have a little bit of a growth story in Asia for them and in Mexico with Walmex. And so at this time, hey, the stock's up. The stock is up 15% on the year. For a market that's flat. So
that's amazing. I mean, the 10-year average on that stock is like $50, right?
Right, exactly. And so it's finally gotten to a price that is, to a valuation that is correct for where it's at. And so it's actually attractive on that level. So I'm not, so if we get back to a story of gung-ho growth, sell this puppy right away. But we're in this environment where it's a little bit dicey, this is safe. The 2.7% dividend yield.
I was going to ask you about the yield. Yeah,
better than the bank account, right?
You're going to park money there. Yeah. What do you got, Kevin?
Mine is the HAIN Celestial Group, ticker HAIN, and they are in the diversified food industry, and they really do it all. They manufacture, they distribute, they sell organic foods, natural foods, and all of this stuff. In fact, they're one of the largest natural foods producers and purveyors in the entire industry. And if you take a look at the industry, that industry really is continuously growing, actually by leaps and bounds.
People spend more money when they go to Whole Foods, right?
You know, everybody wants to get healthy, and it is a growing trend. And Whole Foods, they have a great expansion plan as well. But if you were to take a look at Celestial, they're kind of like a conglomerate in this space, if you will, because not only do they do natural foods and organic foods, they also do skincare, they do personal products. And interestingly enough, they actually sell a wide array of cleaning products as well. So virtually anything you're looking to use in your everyday life, these guys have their hand in it. If you take a look at their growth rates too, I like the way they expand because they do a lot of acquisitions. So oftentimes if you are acquiring these different companies that already have a presence, oftentimes that can be accretive to the bottom line almost instantly. So that's pretty cool. If you were to take a look at some quick stats, here you go. They have a 20% projected growth rate, not only for this year, but also for the next year, so that's 2 years out. Margins are fantastic. They continue to expand, which is really nice to see because that means every single sale, there's more of that going to the bottom line. Great valuations. The thing that I like the best is they have a price to sales ratio of 1.3. That's nice. Lower than their industry, lower than the S&P. And one lesser known fact is there has been a lot of insider buying. I believe that, that insiders bought 1.23 million shares. Clearly, they are in love with their own stock. That represents about 3.5% of the float. And if you take a look at really what's happening, you can see earnings estimates are just skyrocketing across the board. Chart-wise, I have a price target, or chart-wise, if they can get through 35, because that has been confining the market really for like the last 4 or 5 months. If you can get through 35, there is a chance you can climb to 45. That is a 28% increase from here.
All right. I've got CELG. This is your blue chip biotech. 30 billion market cap, but you're going to get 20% growth that you're not going to get with an Amgen or a Biogen. All right, big oncology pipeline here. Revlimid is their big drug. 820 million in sales last quarter, which was up 28% year over year. Now that's 65% of their revenues, but they beat on earnings, they beat on revenue last quarter, and analysts scrambled to raise estimates for next year. They're going to earn over $4 projected. That makes it trade in a mid-teens multiple, and with a 20% growth rate, I think it's a buy here, breaking out above 65 on the chart, and I see this stock at 75 within a year.
Hey.
All right, guys, thanks for the stock picks. We'll be back next week.